You're listening to HECM World Weekly, the nation's only weekly podcast bringing reverse mortgage news to you, the mortgage professional. There are reverse mortgage calculators, but then there are reverse mortgage point-of-sale solutions. Lenderful Solutions helps you get more loans, retain more customers, and even make online applications a reality. To learn more, visit lenderfulsolutions.com.
Hello, and welcome to HECM World Weekly. I'm Gabrielle Hayen. This week, we're looking at several stories that all point toward the same bigger trend. Housing wealth is becoming increasingly central to retirement planning, financial flexibility, and even broader economic opportunity. We'll cover new data showing homeowners are tapping equity at the highest levels in years, encouraging signs from the housing market, new research on general wealth and housing, a proposed bill aimed at encouraging seniors to downsize, and key updates from NRMLA's Western Regional Meeting in California. Let's get started. One of the biggest housing finance stories this week came from ICE Mortgage Technology's latest Mortgage Monitor report. The report found that homeowners withdrew equity during the first quarter at the highest level since 2021. What's particularly interesting is how they're doing it. Instead of refinancing their first mortgages, many borrowers are choosing home equity lines of credit and other second lien products. Why? Because millions of homeowners are still holding mortgages with rates around 3% that they secured during the pandemic years. They're not eager to give those loans up. As a result, homeowners are increasingly looking for ways to access liquidity while still preserving their existing mortgage. More than half of all equity extraction during the quarter came through second liens, and nearly 4 million homeowners who originated mortgages between 2020 and 2022 now also have a second lien attached to their property. For the reverse mortgage industry, this is an important signal. Consumers are becoming more comfortable viewing housing wealth as an active financial resource rather than simply an asset that sits untouched. And while younger homeowners may be turning to HELOCs, older homeowners have additional options available through reverse mortgage products that can provide access to equity without required monthly mortgage payments. There is also some encouraging news from the broader housing market. The National Association of Realtors reported that existing home sales rose 3.2% in May, reaching the strongest pace we've seen so far this year. Inventory levels also continued improving, while first-time buyers accounted for 35% of purchases, the highest share since 2020. Now, nobody would call this a booming housing market. Mortgage rates remain elevated and affordability challenges certainly haven't disappeared, but there are signs that conditions are stabilizing. Income growth has recently been outpacing home price growth in many markets, helping improve affordability and bringing some buyers back into the market. Many retirees who might once have considered downsizing are finding that today's replacement housing costs, insurance premiums, taxes, and interest rates can make moving less attractive than expected. That helps explain why aging in place continues to be such a powerful trend. Many homeowners are choosing to stay where they are and look for ways to make their existing homes work better for their retirement needs. One of the most thought-provoking studies has come from the National Bureau of Economic Research. Researchers analyzed data from more than 3 million American families and found that housing wealth is passed from one generation to the next more effectively than income itself. In other words, where your parents sit on the housing wealth ladder may increasingly influence where you end up. The effect is particularly pronounced in expensive housing markets such as Los Angeles, New York, Miami, and San Diego. Researchers found that housing wealth has become one of the most strong predictors of future housing wealth. And with an estimated $124 trillion expected to transfer between generations over the coming decades, this trend could become even more significant. For reverse mortgage professionals, this highlights an increasingly important conversation. Many older homeowners are balancing two priorities. On one hand, they want to preserve their own retirement security, and on the other hand, they often want to help children and grandchildren who face very different housing affordability challenges than previous generations. These conversations around inheritance, family support, housing wealth, and retirement planning are likely to become increasingly common in the years ahead. That brings us to an interesting policy development. A new proposal in Congress called the Nest Egg Protection Act would increase the capital gains tax exclusion for homeowners over age 65 who sell long-held primary residences. The goal is simple: encourage more seniors to downsize and free up housing inventory. Supporters argue that many older homeowners remain in homes that have appreciated substantially over decades and face tax consequences that discourage them from moving. But this conversation raises an important question. Should housing policy encourage older Americans to move? Or should it focus on giving them more options? For many retirees, remaining in their homes isn't simply a financial decision. It's connected to community, family, relationships, healthcare access, independence, and quality of life. While downsizing makes sense for some homeowners, many others strongly prefer to age in place. That's why this issue is particularly relevant for the reverse mortgage industry. The goal shouldn't simply be creating more housing inventory. It should be creating more housing choices. For some homeowners, that choice may be downsizing. For others, it may involve using existing home equity to remain safely and comfortably in the home they already love. As America's population continues aging, flexibility may prove just as important as mobility. This week also saw reverse mortgage professionals gather in Irvine, California for NRMLA's Western Regional Meeting. Several themes emerged from the event. Industry leaders provided updates on advocacy efforts in Washington, including successful efforts to preserve funding for housing counseling programs that support HECM borrowers. Housing counseling remains one of the most important consumer protections within the HECM program, so this was a meaningful development. Another major focus was reverse for purchase. Multiple sessions explored how traditional financing often fails older homebuyers whose income profiles don't fit conventional underwriting standards, despite having significant assets or housing equity. Reverse for purchase continues to be viewed as one of the industry's most significant growth opportunities. The conference also looked beyond lending itself. Discussions explored aging in place, technologies, caregiving trends, age tech, innovations, artificial intelligence, and the role home equity may play in helping older adults remain independent longer. Perhaps the biggest takeaways was that the reverse mortgage industry increasingly sees itself as part of a much broader retirement and aging ecosystem. The conversation is no longer just about loans. It's about helping older homeowners navigate housing healthcare, caregiving, technology, and financial planning in an increasingly complex retirement landscape. Finally, the industry learned this week that FHA Commissioner Frank Cassidy has stepped down from his position at HUD. Although his tenure was relatively short, Cassidy oversaw several initiatives relevant to housing finance, including efforts to expand alternative credit reporting, update loss mitigation programs, and gather industry feedback regarding potential improvements to both the HECM and HMBS programs. Leadership transitions at FHA are always closely watched because of the agency's central role in overseeing the HECM program. For now, there's no immediate impact on borrowers, but the industry will be paying close attention to whether conversations around future HECM modernization continues moving forward. This week's stories all pointed toward the same broader reality. Housing wealth is becoming increasingly central to retirement security, financial flexibility, and even economic opportunity itself. Homeowners are tapping equity at growing levels. Housing affordability remains a challenge. Policymakers are looking for ways to unlock housing inventory, and the reverse mortgage industry continues evolving to meet the changing needs of older homeowners. Perhaps the biggest takeaway is that retirement planning and housing planning are becoming increasingly intertwined. The question is no longer whether older Americans have housing wealth. The question is how they choose to use it. For some, that may mean downsizing. For others, it may mean aging in place. Increasingly, the key is having options, and helping homeowners understand those options may be one of the most important roles the reverse mortgage industry plays in the years ahead. Thanks for joining us for HECM World Weekly. I'm Gabrielle Hayen, and we'll see you next week.